These are high quality stocks that are at its 52-week low. So besides that, we'll be covering Kim's and Hers stock, as well as some questions left in the comment section below. So let's talk about quality stocks that are near its 52-week low. And the first stock that we'll be covering is Copart. So Copart year to date is down around 15%. It's currently trading at a 31 times earnings. So for Copart, the primary headwind for the business is simply just your robo-taxis, because Copart, what they rely on is for car accidents to happen, and when you have more robo-taxis on the road, there'll be drastically lesser accidents happening on the road, and that will lead to less cars being totaled away for Copart to basically sell on their platform. For Copart, if you're to look into the metrics itself, the metrics are quite remarkable for a company like this. So they have ROE of around 18%, ROIC of around 13%, ROCE of 18.9%, and even during the COVID year in 2020, the company still managed to grow its revenue by around 8%. So it clearly shows that the company has some form of resilience even during a down year as well. So even in 2020 when we had the COVID lockdown, Copart was still able to grow its revenue at around 8%, and this shows that the company is a high quality one. So for Copart, there are some arguments against it. So number one, the company could be in a slow and steady decline with increased robo-taxis that lead to lower accident rate. So for Copart, the primary business model is they have agreements with insurance companies to basically allow the insurance companies to sell the cars on the Copart platform when all the cars are basically damaged after an actual accident. But the company has been diversifying out of getting cars from insurance companies, which will reduce the risk of robotaxi. So far, the company hasn't really acknowledged the risk of robotaxi yet, which is what I don't like from the management itself. But the company's fundamentals are quite incredible for a company like this. So this is a stock that I'm monitoring. Hopefully it drops a bit more on Tesla's robotaxi news. Next stock is Google. So Google year to date is down around 14%. It is currently trading at an 18 times earnings, below a $2 trillion market cap. So for Google, despite ChatGPT coming out over the past 2 years already, this company has still been able to grow its ROIC metric and its ROE metric as well. So ROIC metric has gone from around 16% back when ChatGPT came out to 21% today. And for Google, here are some of the arguments against Google. So the first argument is that they need Gemini to stay ahead in AI, but Gemini could weaken the traditional Google search and it will cause the margins to compress over time because their AI offerings are currently a lot less in terms of the operating margins as compared to their traditional Google search. But so far, we're not seeing it yet in the numbers. And Sundar Pichai has said that AI searches are as profitable as the traditional Google search. So all the AI overviews and the AI mode, they're actively monetizing those. So we could see those coming into play over the next few years. But for Google, if you're buying the stock today, you should be careful of the DOJ lawsuit next month. So the settlement result will come in August or so, which is next month. And if the worst case happens, if Google is told to sell their Google Chrome services, then you can expect this stock to drop another 10-20% or so. But currently, this stock is providing a very decent valuation. For the biggest company in the world in terms of their net income, I think this company today at an 18 times earnings is more than reasonable. Next stock is Corp. So Corp year to date is down around 12%. It's currently trading at around 27 times earnings. So for Corp, this is what is great about the company. The company has a lot of its revenues coming from recurring streams. So for example, over here, this is Corp's 2022 estimated sales profile. And as you can see, 61% comes from non-discretionary sales, 22% comes from somewhat discretionary sales, and 17% comes from discretionary sales. So for the somewhat discretionary portion, it is more of the renovation and the remodeling. So for your pools, they typically last up to around 10 years or so. And after 10 years, they have to be renovated and remodeled as well so that it keeps the house fresh. So for Corp, this is what I like about the business. The company has an existing installed base that will give them recurring revenue every single year. So that contributes to the predictability of the cash flow of the company because you can expect them to continually receive revenue from all these different installed base portions even during a down year. So this is what is not so strong about the company. So the company faces risk in the housing market. So the housing market over the past few years has been on a decline simply because of the high interest rates. So ever since 2022 when the interest rate shot up, you're seeing the housing market in sort of like a slow and steady decline. And that is a headwind for Corp as well. Because when you have high mortgage rates, it leads to less houses being bought, which leads to less pools being built as well. And that's why you're seeing the construction portion of Corp's business declining over the past few years. And the other portion that is bad about the business as well is your chlorine prices. So for Corp, they have around 15 to 20% of their revenue coming from chlorine sales. And for chlorine, the prices shot up in 2020 after COVID. And ever since then, the prices have been on this steady decline over the past few years or so. And it is forecasted to fall even further So for Pool Corp, they don't make their own chlorine, they buy the chlorine from the supplier. But the problem with the declining prices of your chlorine is because it will lead to lower margins for Pool Corp. So for Pool Corp, if their costs are fixed and your prices of your chlorines come down, then that will hurt the margins over time, and that's why you're seeing the ROIC metric coming down for Pool Corp. So for Pool Corp, it is one of Warren Buffett's buys as well. So Warren Buffett actually doubled his position in this recent Q1. And for Pool Corp, it's a company with depressed earnings and depressed sentiments as well. And Warren Buffett is clearly buying this because it is a quality company in a very niche space. It's undergoing some form of downturn and is nearing its inflection point soon. So for this year, the management is forecasting around a flat to 1% EPS growth. So this could be an inflection point for Pool Corp. And if the company can resume back to growth again, then you will see prices a lot higher than it is today. So for Pool Corp, I view it as a quality company. It is a decent company with depressed earnings, with depressed sentiments, and it is probably a decent time for you to add in a down cycle. It's impossible to predict how the housing market will turn, but so far the company has stayed resilient. So if you were to completely discount away the 2020 boom that they had, if you applied an 11% growth since around 2019, it is around what they're currently achieving now. So for Pool Corp, it's a quality company that has a lot of headwinds right now, which could turn into tailwinds in the future. Next stock is Pepsi. So Pepsi year to date is down around 14%. It's currently trading at an 18 times earnings. So Pepsi is currently at its 52-week low. So for Pepsi, they have a suite of products. They have a lot of quality brands under them. So they have Lay's, Quaker Oats, you have Gatorade as well, and then you have the traditional Pepsi. And for Pepsi, what they're doing is they're acquiring a lot of companies to basically boost out the growth of the company. And for Pepsi, they have quite decent metrics as well. So they have ROIC of around 13%, ROCE of around 20.4%. I would neglect the ROE because the company has a lot of leverage. And when a company increases their leverage, what happens is it will depress their equity, which will lead to higher ROE. So I would neglect this one completely. But for a food company to have 13% ROIC is quite incredible as well. So for Pepsi, the problem with the business is that the volume is declining and it's a recipe for disaster. And they're going through taking on more leverage. If it gets dirt cheap, if it gets to around a 15, 16 times earnings, it is one to look at given the predictability of the business and the surprisingly good metrics of this company. So if Pepsi can drop down to a 15, 16 times earnings, then it will be one for you to look at. The company has around 10% more to go, so let's see if it reaches there. Next portion, I'll be talking about Hims and Hers stock. So Hims and Hers stock today is down around 30%. It's currently trading at a 63 times earnings despite this drop today. So for Hims and Hers, the reason why the stock dropped is because Novo Nordisk, they cut their ties with Hims and Hers over compounding violations. So as you can see, Novo Nordisk has terminated its collaboration with Hims and Hers, citing illegal mass compounding and deceptive marketing around Wegovy. So Novo said that the compounding practices violate federal law and put patient safety at risk, especially as knockoff versions often use unregulated semaglutide sourced from Chinese suppliers with no FDA oversight. With the nationwide Wegovy shortage now resolved, Novo is doubling down on ensuring only safe, approved treatments reach patients. So for Hims and Hers, they have around 15% of their revenues coming in from GLP-1 drugs. So it is forecasted this year as well that they will have around 35% of their total revenue coming from GLP-1 drugs. And this deal falling off could be a massive headwind for the company as well, along with the lawsuits coming in from Novo Nordisk as well. So CT actually estimated that the GLP-1s accounted for around 130 million of Hims and Hers revenue in Q4. And they also said that now that semaglutide is off the shortage list, we think revenue guidance of 56 to 63% year-on-year growth is aspirational, as it assumes 725 million of revenue from weight loss products. So with this deal now off the table as well for Hims and Hers, this could be a long-term headwind for the company, and that's why you're seeing the company dropping 30% in one single day alone. So in general, I think the healthcare industry is one for you to avoid, and for Hims and Hers especially, it is more of a speculative stock that retail is chasing. So for me, I'm staying out of this one. I don't think the company offers enough predictability for you to buy into the company. Last portion, I'll be covering some questions left in the comment section. So the first one, it says, I get that holding cash makes sense at times, but I'm wondering, have you ever compared the impact of staying in cash versus being invested, even at average or high valuations? This is Warren Buffett's cash pile over the past few years, and he currently now has around 30% of his assets in cash as well. So yes, over the long term, valuations don't matter as much, maybe over 10 years, 20 years or so, but in the next 4 years, under Trump's administration, I expect a lot more volatility ahead as well, and that's why I'm holding such a proportion of my portfolio in cash. And Warren Buffett is clearly seeing the same as well. I don't think he is so much into speculating what Trump will do, but he clearly sees that the market valuations are high right now, and that's why he's been selling out of his positions. So in summary, over the long term, market valuations don't matter as much, but of course, if you're buying at bubble valuations, then it will matter. I'm currently actively sitting out of the markets today because the markets are overvalued, but I'm hoping for more opportunities in the future, maybe a short mild recession for me to buy into stocks again. Next comment, it says, "Hey Guan, I know you can't give financial advice, but given current valuations, will you personally invest in Baba or Amazon for a long-term hold? Which offers the better risk to reward ratio?" So for me, I think Amazon is the high quality business. Baba has a lot of headwinds and a lot of risk associated with the company as well. So Baba has the regulation risk with the government, has the consumer risk in China as well. And for Alibaba, the problem with the business is it's still reliant on its consumer side to make a lot of its money. For Alibaba, around 80% of its total net income actually comes from the Taobao and Tmall portion. There's only around a 10 to 20% comes from your cloud and other segments as well. So for Alibaba, in the short term, I view it as a company that could potentially make you more returns as compared to Amazon. But if you're a long-term investor, I think Amazon is the much higher quality business, currently trading at its lowest valuation ever, that could provide you a lot more upside in the long term ahead. So in summary, Alibaba or Amazon, I think Amazon is the company that will provide you with greater upside in the future, and that's why it's one of my core positions in my portfolio. For Alibaba, it is a quality business that has a lot of catalysts coming up behind, but this company has a lot more risk compared to Amazon. So if I were you today with a long-term mindset, I would prefer buying Amazon as compared to Alibaba. I hope you guys have found this one useful and invest safe.